Hi everyone, Victor Monash here, Senior Partner with Ystreet Capital. Our development firm is active across much of the United States. We're developers of multifamily apartments, of storage, of some light industrial, and we do a fair bit of land development as well. We are deep in the fourth quarter, which means, yes, some winter weather, but also means taking the time to do some last minute tax planning. Maybe you made a little bit too much money this year and you're anticipating having a tax problem. This upcoming segment with CPA Mike Pine is going to be absolutely vital for you. We're going to be talking about how you can use depreciation to offset some other forms of income. It's going to be very valuable. We'll talk to you soon. Enjoy.
I can hear you. There you are.
So let's see where we are with attendees. 106 registered for tonight, so that's great.
Nice.
Well, welcome everyone. Welcome to our session tonight where we're going to be talking all about depreciation. A very exciting topic, especially if you're a CPA like Mike Pine, our guest tonight. And we're going to probably keep this to about 30 minutes in total. We're going to start with, we're going to run this interview style where I lead Mike through a series of questions that kind of frame the topic from an investor perspective. And then we'll open it up to questions from folks in the audience as well. So I think we could probably even start. We will have the recording available for those who either show up late or can't make it but want to see the replay. So we can, I think we can dive right in. So maybe why don't we start, Mike, with some introductions. I'll start with myself. I'm Victor Monash. I'm one of the senior partners here at Ystreet Capital. We're a development company. We develop real estate all across the United States and a little bit in Canada. We develop multifamily apartments, storage, senior housing, flex multi-tenant industrial, and we have a few thousand acres of land in our development pipeline as well. So over to you, Mike.
Yeah, hi, I'm Mike Pine, and I agree with Victor, and I don't think we're joking. Depreciation is incredibly exciting. It has the power to change your life big time. It has the power to change investment ROIs of multiple of 40, 50% just by getting that depreciation. I have a firm here in Dallas, Fort Worth, where we focus mainly on real estate and just proactive tax planning. And I'm excited to be here, Victor. Thanks for having me.
Well, thank you for being here. And one of the things I love about Mike and his whole team is that they're not just a commodity CPA. And I mean that very deliberately, because there are folks that are just transactional. They do the compliance work and that's it. And they see you once a year and thank you for the check and see you later. And Mike and his team think strategically. So it's about structure. Tom Wheelwright is famous for saying, if you want to change your tax, change your facts, which means make sure not just are you receiving money, but what is the structure under which you receive that. And I believe that because the tax code is not just a way of extracting revenue from the population. It's also a series of incentives. And those incentives are really giving you hints on what to do, what the government wants you to do, and how they're incenting you to do that through the tax code. Because if it was simply a matter of extracting money from the population, that could be done in a couple of dozen pages, and there's thousands and thousands of pages, which is all the different ways of giving the money back. So that's my perspective. So I'm excited to have this conversation. So Mike, let's start with the basics around, and we're not going to talk yet about bonus depreciation or cost seg or any of that stuff. We'll get to that. But let's just talk about how depreciation expense can be used to offset income for those that are investing in multifamily real estate and how that can be advantageous.
Yeah. How about I start off with a quick primer on what depreciation is? I mean, I think we all have a concept, but let me just back up a minute. The IRS says, and our tax law says, if you buy an asset that you're going to use in a trade or business, you can't deduct it immediately, generally speaking. If it has a useful life of more than 1 year, then whatever the useful life is, as prescribed by the IRS, is how you can get your deductions over a period of years. For instance, if I want to be a taxi cab driver and I go buy a $10,000 car, the IRS says that car has a 5-year useful life, even if it's a taxi. They don't differentiate. They don't make it real. But they say that car has a 5-year useful life, and you pay $10,000 for it, we'll let you deduct it over 5 years or $2,000 a year, again, generally speaking. So that's what depreciation is. Where it gets really exciting for me is in real estate, in your world. The IRS lets us depreciate assets we use in trade or business, but some assets actually appreciate in real value. So with real estate done right, you can buy an asset that's appreciating in value, going up, but the IRS is letting you take a deduction as if it was depreciating in value. That's huge. So you have an asset, it's going up in value. The IRS is giving you a tax deduction for it. It's even providing you cash flow, but you're getting a tax deduction for that depreciation. There's different ways of handling on different people's tax returns, though. Real estate professionals, they're kind of in the promised land of taxes. But I hear, and this drives me nuts, Victor, I hear so many times I'll get a prospective client that calls up for a consult, and they'll say, yeah, but my CPA told me all this depreciation on this investment isn't going to help me because I'm not a real estate professional. And that is absolutely wrong. Completely, categorically wrong. You don't get the same benefits at the same time frame that a real estate professional does. But if you buy an asset, invest in real estate, and you're receiving depreciation, that depreciation can offset that investment's income. It can offset, if done right in your tax return, other passive income streams as well. So I wish I had this chart up. I built a chart a few months back that shows the difference in ROI on an asset investing in real estate through syndication versus taking the same investment, getting the same cash flow return. It was 8% ROI, getting cash on cash 8%. But then we added in the variable of, well, do we get to take depreciation and utilize it? And we did this for passive investors. So they're not real estate professionals. Those operating distributions they got, in some cases for 7 years, were tax-free. So if you got the same dividend from a stock, you're going to pay tax on that as soon as your cash comes in your pocket or that tax year. If you get a distribution from an investment in real estate and it's got depreciation, even if that's your only investment, you're not going to pay tax on it for a while until you've used up the depreciation that you couldn't use in the first year like a real estate professional can. And you compare that in 5 years, you're going to get a rate of return almost 30% higher over that time, just from the fact of depreciation. And that's not assuming you're compounding it. If you take those tax savings you get each year and reinvest that, then you really see a huge delta between tax advantage investments and regular Wall Street investments. You can snowball a heck of a lot faster in building financial freedom.
Absolutely. Now, one of the counter arguments that I often hear, that I'll put that in the rumor category, although there is truth to it, is why bother taking depreciation, because it's going to lower your cost basis and there's depreciation recapture and you're going to end up paying the tax anyway. What say you?
If you completely ignore a very important concept called the time value of money, and if you assume that depreciation recapture was, let's say you save $10,000 in taxes this year, but you're going to have to pay that exact same amount when you sell the asset in ordinary income through depreciation recapture, which is not the case, because the longer the asset's held, the lower your depreciation recapture is going to be. But even if that were the case, if I were to invest $100,000 with you, Victor, and I got to take $40,000, $50,000 of depreciation this year, and that reduced my taxes by $15,000. If I have that $15,000 in my pocket for the next 5 years and then have to turn around and pay it to the IRS, basically I just got a $15,000 interest-free loan for 5 years. Now, if I just go spend that at the beach, then the time value of money doesn't really matter. But if I take that money and grow it, it matters hugely. So whatever the delta is, even if the worst case scenario were whatever tax savings you have today, you're going to pay back a depreciation recapture when the exit comes. The delta between what I can make with that money today for the next 5 years, 7 years, 3 years, That's a permanent difference that I got to keep. So if you ignore the time value of money, I kind of can buy that argument. But who ignores the time value of money that knows anything about finance, right?
Exactly. So that's a natural segue. So when we're talking about time, the standard depreciation, if you're talking about a real estate asset, is 27 and a half years. Let's talk a little bit about taking that real estate asset and picking it apart into its constituent components. This is the land. These are the improvements. The refrigerators are depreciating a lot faster than the roof, a lot faster than, say, the asphalt, and so on. What's the advantage of picking apart an asset into its constituent components like that through cost segregation?
Well, the time value of money creates the major advantage. Hopefully this is not too elementary, Victor, but if I can back up what picking those components up really looks like, what does that mean, taking them apart or segregating them out? Perfect example is I'm under contract to close on a rental home, single family rental home at the end of this month. I'm paying $550,000 for that house. The IRS would say, hey, if you're going to depreciate that, you can depreciate over 27 and a half years straight line. But the IRS technically says you shouldn't do that, because when you bought that house, you didn't just buy the sticks, the frame, the foundation, and the roof. You bought everything that's inside: the flooring, the countertops, the cabinetry, wiring, plumbing, et cetera, et cetera. All those things we say you have to depreciate over a faster period, over 5 years or over 7 years, or all the land improvements, the driveway, over 15 years. I did get a driveway with this house. When you break those out, you're accelerating the depreciation. Instead of taking that depreciation over 27 and a half years, you're taking a lot of it over 5 years and over 7 years. So you're increasing the tax deduction, not the cash. Doesn't in fact cash at all. You already bought the asset, but I'll be increasing the tax deduction in the first 5 years, the first 7 years, if I don't even go into bonus depreciation.
So that's a natural place to segue back into the prior discussion on depreciation recapture. So am I right in saying that you buy a property, you hold it for 5 years, you depreciate your 5-year property as part of that cost segregation over those 5 years. You still have 10 years left on the 15-year property, and you still have 22 and a half years left on the 27 and a half year property, and so on. That 5-year property now no longer comes back into your recapture because it is fully used up. Is that right?
Kind of, sort of. What it really comes, the reason, well, depreciation recapture is a hard concept to teach because it's a hard concept to calculate for each and every individual taxpayer, depending on whether they took any depreciation against their active income versus their passive income. Generally speaking, yes, the longer you hold the asset, the less your depreciation recapture is going to be. And you could generally say what you just explained is a good rule of thumb, but it's not always going to calculate out that way.
Understood. And by the way, I probably should have said this at the very beginning. We're not here to provide you tax advice tonight. I'm certainly not. If you said to the IRS, where did you get your tax advice? And it was from some dude in Canada, that would probably not go well. Yes, that's why we have Mike Pine here, who is a rock star CPA with us. But even then, your mileage will vary based on your own individual circumstance. So we're here to educate you to ask the right questions of your own CPA, unless Mike's your CPA as well, in which case that's awesome. But ask questions of your own CPA that are specific to your own personal circumstance. So, okay, so we're understanding a little bit better recapture. Now let's talk about bonus depreciation that a lot of people are very excited about, of course. It's one of these things that is going away slowly, bit by bit, but still attractive this year and next and the year after that.
Yeah, very attractive. Right now, the law that was passed under the 2017 Tax Cut and Jobs Act It said we get 100% depreciation, bonus depreciation from 2017 to 22, and that starts going down 20% per year. This is the first year that's gone down. In 2023, we could take 80%. Next year, assuming all the laws stay the same, we'll get 60%, and then until it finally goes away, 20% per year in 2027. Even if it goes away, cost segregation, accelerated depreciation, time value money don't change. I worked on my first cost segregation at PricewaterhouseCoopers in the year 2000, before we'd ever had anything called bonus depreciation. And it was something that had been around for 2 decades at that point, because it was still very beneficial to the real estate owners. And then the IRS actually prescribes it in their tax law. They say you have to depreciate stuff based on our class lives. And we say that refrigerator in the house you just bought has a much lower life, a 5-year life versus the 27. So you're actually breaking in the rules with the IRS by not doing a cost seg. But they don't mind, because you pay more taxes if you don't. They like the time value money too. But even getting 60% bonus or 40% bonus, when you consider time value money, it's a heck of a lot better than getting 0% bonus. But honestly, and I shouldn't do this where I'm being recorded and people are going to see this by predicting the future. Bonus depreciation has been around in some shape or form ever since 9/11 happened. It was the first retroactive tax cut I got to experience in my career. In 2002, they passed the bonus depreciation law and said, for any assets you bought in 2001, you get to take it. It was only 50% back that day. It has survived and been renewed and expired and been renewed by 4 administrations now. It comes out, it's been Republicans that renew it, Democrats renew it. Every time it expires, there's a bipartisan uproar. There's still some bipartisanship, even on tax cuts here in America, that it helps the economy. It's been proven over and over now for over 2 decades. When you allow businesses to deduct the expenses they pay to place assets in service, businesses will invest more in business. Like you mentioned, the entire tax code is a series of incentives that our society and our Congress has come together and say, this is what we need for the betterment of our country, whether it's to lift all boats or to provide affordable housing, it's in there. And bonus depreciation, even though we don't have enough affordable housing yet in this country, we have a heck of a lot more than we did 20 years ago, because businesses were able to take a tax deduction by investing in capital. So I will be shocked. And again, I shouldn't say that because I've been shocked by our politics in this country a lot over the last 7 years. But I will be absolutely shocked if, no matter who's in office and who's running for office next year, if they don't reinstate it. It's already been the Republicans in Congress have passed 2 bills already trying to reinstate it. Both of them were going to make it a retroactive 100%. Didn't get anywhere in the Senate yet. But next year's an election year, and that's good for taxes. I think we'll see some good changes in that, and I think it will come back.
Fascinating. So let's talk a little bit about depreciation expense and how that can be used to offset income. Some investors choose to invest using retirement funds, whether it's in an IRA, whether it's in a Roth. Can you talk a little bit about the impact for those who are investing using retirement funds versus cash?
Generally speaking, retirement funds don't pay tax, so they don't really need the tax benefit. They don't get any benefits. So tax deductions can only reduce your taxes that you already owe. So it doesn't help retirement accounts, generally speaking. It's good to get an asset class besides Wall Street in your retirement portfolio, but you're not going to get any tax benefits passed to you if you invest through your self-directed IRA. However, there's this thing called UBIT, unrelated business income tax. When you invest in debt-financed investments, like real estate, you don't go pay 100% down to buy an apartment complex. You pay maybe 20% down and you finance the rest, or 30% down. The IRS, as part of their rules that they made a long time ago, and a lot of the Treasury Department really promulgated these rules, but they say that they thought, hey, we don't want people investing their retirement money we don't want them trading on margin, basically, in their retirement account. So they came up with these debt finance rules and say, if you're debt financed, in order to steer people away from that, then any income you get from debt finance is going to be taxable income, even to a retirement account. Suddenly your retirement account has to pay taxes, which is completely not the point of putting money in a tax-free retirement account, right? So that only applies to all investment accounts besides 401ks and a few others. But IRAs, if you have an IRA, self-directed IRA, if you invest in something that's debt financed and get taxable income from it, you have to pay UBIT tax, or you're supposed to. However, to calculate UBIT, you're supposed to follow the same rules that we would follow in determining your taxable income. And they say, well, you don't have UBIT if you have depreciation in excess of your operating income. So even for IRAs, depreciation is helpful because it prevents them from having to pay UBIT. They get a bunch of depreciation allocated to them during bonus depreciation years, a whole bunch in the first year. And then in year 2, year 3, they're hoping, expecting, and like your funds do, they perform and get income allocated to them and cash flow distributions allocated to them. Well, if they have a big depreciation roll forward that they didn't get to use, basically a net operating loss carry forward, they are not hitting UBIT until they've used up all their depreciation. So that's helpful. But then just one other tidbit, you're not stuck paying UBIT if you're in an IRA. You just roll it over into a self-directed 401k, and 401ks are not subject to UBIT. But again, depreciation doesn't really help the 401k. It's just the asset class that you're invested in that helps it.
I love it. So let's talk a little bit about investment structure and how this can affect things. So sometimes people invest in a single discrete project, could be a syndication. Sometimes they invest in a fund that may have multiple assets under that, each in their own subsidiary entity that are invested in by the fund. Can you talk a little bit about the impact of depreciation or bonus depreciation in those projects? If they're in a fund structure, is it any different than if it was a discrete investment, assuming they're all flow through entities with a partnership election on their tax return?
Yeah, the same partnership tax law applies to funds versus single-use entities or single-purpose entities, as long as they're all passed through. It's partnership tax laws. I happen to love partnership tax laws, and they're a lot even more interesting than depreciation, Victor, because they say you can allocate income and expenses, allocate items like depreciation in any manner that has substantial economic effect. Now, that alone is thousands of pages of write-up to figure out what that means. And a lot of people, even the IRS, still haven't figured it out. But some funds can say, all right, we're going to allocate depreciation to all the people that were only invested when we bought this asset. That's allowable. Some funds will say, no, we're going to let even the new investors share in it because we're helping diversify the original investors. You just got to read the operating agreement and the offering memorandum to understand how's that depreciation going to be allocated. But you get the depreciation benefits regardless of whether it's a fund or an LP. You just don't get them if it's a REIT. A lot of people, or one of those publicly traded partnerships, a lot of people don't realize that. But you don't get to take deductions. You don't get the benefits of depreciation in a publicly traded partnership. You do in an actual partnership.
Oh, fascinating. So what are some of the main highlights that you think we've missed before we open it up to questions?
I would just like to kind of follow on what you started in the beginning and with what Realright says about taxes, and he's absolutely right. The tax code, I think this is his quote, less than 0.5% of these tens of thousands of pages of tax law actually address the levying of taxes, the assessment of taxes. But 99.5% or more of the tax law addresses and tries to incentivize our society to do things, to do our patriotic duty. I love Canada, Victor, but I want America to win first, and I'm going to follow these laws to do my duty for America. and I think we should. You can choose. Tax law is not sexy for most people. Forgive me. I think it is, but I get it. I'm not like normal people. You can choose to either be oblivious to it or to stick your head in the sand with it and just be a victim to taxes, which is what you are. You're being a victim unless you choose to utilize it, embrace it, and leverage tax law to help you build your financial freedom. I think the tax code, the Internal Revenue Code, to me is a yellow brick road of how to find financial freedom. If you could add, just again, consider the time value of money and compounding. If you could increase your ROI by 20% or 30% a year by mitigating your taxes and doing proactive tax strategy in your life, imagine what that does to you 10 years from now or 20 years from now. You're basically investing more money because you're getting the government who took your money, you're getting them to give it back to you so that you can make these investments. So make a choice, change your facts, like Wheelwright says. Embrace the tax code and use it to leverage your financial freedom growth. That's my last comment before I open it up.
Okay. So we have a couple of questions already in the chat window. If you have questions, put them in the chat or in the Q&A. Either one, we'll definitely get to them. The first one's from Monica, who asked, what's the benefit of real estate professional status? We touched on it, but we didn't actually explain it.
Yeah, so there's the IRS, the rules require us to track and report income in 3 separate buckets. You have your active income, which is your W-2 income if you own a business, you're self-employed, or even if you're retired and receiving pension income. That goes into your active bucket. And then you have things like stocks and bonds and bank interest. That has to be tracked in your portfolio income bucket. And then you have your passive income bucket. For someone who's not a real estate professional, any real estate they're invested in most likely is going to be considered passive. So a lot of people have active income and they have an active income problem, tax problem, or an active income tax opportunity. And if they're a real estate professional and they invest in syndications, and please, this is general advice. It gets very detailed and specific. But generally speaking, if they have a real estate professional and can qualify and invest in real estate, receive depreciation, they can move that depreciation deduction over to their active bucket and reduce their active income, their W-2s, their business income. So that's a huge benefit. They can reduce it right then, that year. Whereas if you're not a real estate professional, any investment you make in real estate goes into your passive bucket, and any depreciation that comes out in your passive bucket is stuck there. You can't move it to active. You can't move it to portfolio. It's going to be in passive. Once passive, always passive. Now you get to carry it forward and utilize it to offset any other passive income. If you have multiple passive investments, you need to work with your tax advisor to make sure you're grouping them correctly in the IRS forms. But you could have 20 investments and 2 of them exiting, but 18 of them providing losses or netting to a loss. You might be able to eliminate all your taxes from that investment.
Love it.
Does that help? Is that a good summary?
Yeah, absolutely. This next question is from Derek, who asks, when someone cost segs, does it clearly state you have X amount of value you can depreciate over, let's say, 7 years? If you use it, but keep the asset for 7 years, when you sell it, will you not have to pay the depreciation back? So that's really the recapture question.
Yeah, you will probably pay some recapture, Derek, but it goes down over time of what's recapture. The basics is depreciation reduces your tax basis. We don't have this issue when we go buy a stock. You go buy a stock for $100, you sell it 10 years later, your gain is based off of that $100 original cost basis. When you have an asset that you're depreciating and using the depreciation, it reduces your tax basis. So you have a higher gain when you pay it. And again, Derek, I would refer you back to earlier in the video where we talk about the time value of money. Yeah, in a worst case scenario, you have to pay it all back in 7 years when you sell the asset. But what did you do with those tax savings for those 7 years? Did you make money with it? Then net, you're way up on the IRS.
Absolutely. This next one is from Robbie, where he asks about self-directed 401ks are exempt from UBIT. He says, I know there's complexity. I thought self-directed 401ks are exempt from UDFI in real estate assets and are not exempt in other asset classes, but are hit with UBIT.
You are correct, Robbie, and thank you for asking that question so I can clarify it. For the purposes of real estate, that's what generates UBIT is the debt financed, and 401ks are excluded from that concern, where IRAs aren't, but they still have other UBIT potential problems. If they invest in a business, or it's just like if the UBIT rules actually came out for charities and then got applied later to retirement accounts, but the UBIT rules say, hey, if you're not doing the purpose of what we hid here, then you have UBIT income. Like if I start a charity, but then my charity opens a hot dog stand and starts making money, that's not the charitable purpose. That's unrelated business income tax. And that's what founded it. So there's a lot of things that can spin off UBIT for the purposes of investing in real estate, though. With a retirement account, you're 99.999% of the time you have to worry about UBIT is when you have debt financed income. And if you're in a 401k, you don't have to worry about it.
Awesome. This next question is from Jerome, and he's asking about advantages and disadvantages between cross-border investing between the US and Canada. And I guess that really applies in both directions, because you could have Canadians investing in the US, you could have Americans investing in Canada, governed by tax treaty. And I know there's a lot of nuance to this, but you want to give us the short version of that?
I honestly think you're more of an expert on this than I am, because you've navigated it well over the years. Every country wants their fair share, or their pound of flesh, depending on how you want to look at it. They want it. If you're investing cross-border, now you are dealing with two tax regimes, not just your home country, your residency country, but you're dealing with the other one. So it does make things more complex. I can speak a lot more to if you're a U.S. taxpayer investing in Canada than the other way around. I know how to report it all right, but it's getting complex, more complicated. I can think of tons of advantages. One of them is you're diversifying in different markets by investing in other areas. But then you have the complexities of having to deal with tax law. And then if you're a U.S. taxpayer and you're investing in another country and it has depreciation, well, suddenly you can't use normal maker's depreciation. You have to use ADS, but it's still beneficial to do cost segs, FYI. So the biggest detriment is complex, and you need to have a professional tax advisor, most likely in both countries or jurisdictions that you're in. I do not know Canadian tax well. Victor knows some great Canadian CPAs out there that he could introduce you to, but we know US well. It just makes it more complicated, more filings. It makes your tax prep stuff more expensive. But if it's making you more money, I wouldn't let that stop you.
In general, when you have non-resident income, that host country for that investment wants to charge you some non-resident withholding tax. If there's a tax treaty in place, how does the IRS treat that tax withholding?
Depends on the tax treaty in the country we're talking about, but generally if you have a tax treaty, you get, generally speaking, again, the tax treaty allows you to have lower withholding rates. The tax treaty also spells out if you get your full tax credit, your foreign taxes paid credit on it. There's some, and it's different kinds of payment streams. Some payments with Canada is not tax. You don't have to worry about withholding. Some payments made to, if here in the U.S., made to members of Canada, there's no withholding requirements, but then some are. I feel like I'm about to go down a very long tangent, Victor. So you want to help keep me on the road here?
Yeah, this is an area that's complex. So this is one of those ones that I would probably put in the category that is, let's say, case-by-case specific. It's structure specific. For example, I know that Canadians investing in the U.S., Americans often invest using a limited liability company as the entity type. That's a relatively new entity type, and it's not really contemplated in the tax treaty. The net consequence of that is that if you, as a Canadian, use that structure, and then bring the funds back to Canada, not only are you going to pay the non-resident withholding tax, you're going to not get the tax credit in Canada. You're going to be taxed fully as if you hadn't paid any tax. So it is complex. Its structure matters. You got to, get your own specific tax advice. So done incorrectly, it is possible to be subject to double taxation, which is the very thing that the tax treaty is designed to eliminate, the double taxation. So you just got to get your own advice that's specific to your structure and probably beyond what we can cover realistically on tonight's webinar. Monica is asking a couple of questions. What about buying a business? She has a few questions. If there's inventory, how's the inventory depreciated?
Yeah, Monica, inventory is not depreciated. You're not actually using it in a business, even though that is your business to sell it, right? So inventory, you don't even get a deduction when you go and buy your inventory. You get to deduct it when you sell that inventory and cost of goods sold. So inventory doesn't qualify for depreciation. It's a cost of goods sold item.
So unfortunately, if you buy clothing and brown is no longer in fashion, and so next year you can't sell it, you don't get the depreciation, and sucks to be you.
Well, no, if it becomes worthless or seriously written down, there's a tax law that allows you to take the deduction or write it off when it becomes worthless or has gone down significantly in value. You get some deduction. You eventually get to deduct the inventory you buy either when you sell it or when it becomes worthless or it gets impaired by something, but you don't get any depreciation for it.
Right. What about living full-time in tax-free states but making income in another state? So this is actually going to raise some very interesting questions. I got a couple of follow-on questions to this one too. So
yeah, I live in Texas. I'm a Texan through and through, even though I wasn't born here. I'm happy to be here. We don't have income tax, and I highly recommend that. It's a great tax planning strategy if you can do it, and if you want to do it. If you have business, if I own businesses in other states or my partner in partnerships in other states, which I am, those states where the activity is or where they determine the nexus, economic nexus exists, they want their fair share, and they expect you to pay it. So if you invest in a syndication that has property in Colorado, I'm getting a K-1 from Colorado. The Colorado tax authorities get that. They're expecting me to pay that. I would love to just add this highlight. I hear so many CPAs and get a lot of clients that we're trying to clean stuff up with, where they say, well, every state has an income filing threshold, which is very true. And if you don't make money or over a certain amount of money in a state, then you don't have to file that state. General rule of thumb, I think you should file in every state you receive a K-1 from. And here's a perfect case in point. We had a client about 5 years ago come in. They just had the sale of an apartment complex that they owned through a syndication in Georgia. They were Texas residents. When we calculated the sale, they had a bunch of passive depreciation loss that they never used, a big net operating loss. But the way it was reported on tax return is 5 years before that, there was a big net operating loss. And they didn't file in that state because they weren't required to. And it saved them a couple $100 in tax prep fees. But the statute of limitations had passed by the time they sold that property. Georgia would not give our client credit for the net operating loss that they should have been able to reduce their gain by. And we've really fought this hard and we lost. They said, look, you did not establish there was net operating loss. There was no return filed that showed you had it, which is ridiculous because they had all the partnership tax returns. And they said, and you can't file it now because at that time it was a 3-year statute of limitations in Georgia. So our client paid like $50,000 more in Georgia state income tax than they should have by saving a couple $100 not filing. So talk with your tax advisors. A lot of them say you don't have to file. Say, well, what happens if I get a gain in 4 years or 5 years? Do I get credit for this loss if I don't file? And you might change your mind to not file or to file in those states.
So let's imagine for a moment that someone invests in a fund and that fund is really successful. Like just off the chart successful, and boy, they have investments in 20 different states. Do you, as a investor in that fund, have to file state income tax returns in all 20 of those states?
Potentially. If you don't have income again, you probably don't have a requirement in most of those states to file, but you may very well benefit by filing in those states. But then there's a couple things that you can do with partnership returns. They can file what's called a composite return, basically saying, yeah, we know this partnership is a partnership for federal tax purposes. It passes through all its income and all of its tax liability to the partners. But here at the state level, all of our partners have elected to have the partnership pay the taxes. So it pays taxes for your benefit, which would remove your requirement to file taxes. But then again, you still might want to file, because if it paid $5,000, if Colorado composite return paid $5,000 of taxes on my benefit, but if I would have filed a Colorado state tax return, should have only had $500 in taxes, that Colorado is going to keep my $4,500 there. Whereas if I filed even with a composite return, and we file, annoys our clients. We say, no, we want you to file in the state to get this refund. And they're like, but it was a composite return. I didn't have to file. Well, that's the only way to get your money back in most cases. Recently, they come up with, when they had these SALT tax limitations that only allow us to deduct $10,000 of state taxes or property taxes. A lot of high income tax states didn't like that, because suddenly the residents were having to pay a lot higher in federal income tax because they weren't getting a benefit for all these real estate taxes or sales taxes they were paying. So states have found a workaround. I think at this point there's 34, 36, over 30 states have prescribed what's called the PTE election, or pass through entity election, where in those states, the partnerships agree to file. It's still pass through, but they're paying the tax burden of the partners at the partnership level. And now the partnership, for federal tax purposes, gets to deduct that state tax payment. And the people who live in high income tax states still get 100% benefit for all the taxes paid in that partnership in that state on their federal tax returns, where they don't. I know I'm opening up a bee's nest here, but you're very likely going to have a lot of state tax filings if you're in a fund that's operating in 20 states. You might not have an obligation, but you're probably, in more cases than not, going to want to file for your own needs and to reduce your overall tax at some point.
Fantastic. Next question from Monica. If you lose money on a fix and flip, is that a capital gain or loss?
It would be a loss. Whether it's a capital loss or an ordinary loss depends if you're in the ordinary trade or business of fixing and flipping. If you've established that you're doing this, then it's treated almost as inventory for you. It's treated as ordinary income producing. You lose the benefit of a capital gain if you sell it at a gain, but you get the benefit of an ordinary loss if you sell it at a loss. The IRS uses that against people who become a professional flipper, because they say, hey, this is your active trade or business. We don't want to give you capital gain treatment. There are ways around it most of the time, but the IRS made those rules. So if you happen to be in the case where you have a big loss and you want it to be an ordinary loss or an active loss versus a capital loss, there's a lot of rulings from the IRS that help you get there if you want it to be. So it can be either or, Monica.
Well, you can tell from this whole conversation that Mike is an absolute expert. There was not 1 second where he said, let me look that up. You know this inside out. You live it, you breathe it. And we went into this literally cold. We had no pre-meeting, and I was confident that you would be able to handle any question that got thrown at you, and you have. So it just is a testimony to your expertise and why we love working with you. So thank you for that. Let's give a moment for one last question. And if there aren't any other questions, we may call it a night. Mike, why don't you give people your contact info if folks want to consider using your firm's services?
Sure. I will shamelessly plug our budding podcast, Hidden Money. Check us out at hiddenmoney.com, spelt just like you would think, hiddenmoney.com. You'll find links there to our website if you want to know more about our actual services, but you'll find a lot of free content, especially in the bonus area. There's a bunch of bonus content. You can learn a lot. And then if you want to meet with us, just follow the links and get clicked through to have a free consult with us.
Awesome. And Monica's asking if your firm is indeed taking new clients.
We are, for the ones that we know we can add value to. So the best way to find that out is do a free consult with someone on our team, and we'll be honest with you. I think we had, as a team today, I think we had something like 18 sales calls, and I think only 3 did we recommend they hire us. But I hope we added value, and I know I did on all my calls, gave some people some really good information that they could use.
Fantastic. And Jerome is asking for recommendations in Ottawa for someone on Mike's level. Conley McNamara is a good firm. John Fruin, Frouin, is excellent. Those are 2 names that come to mind. And then, of course, any of the big firms, any of the big 4, they'll, you can't go wrong with any of those. But yeah, ABFK. ABFK is another firm that we actually use. So, okay. Well, Mike, this was awesome. Thank you so much. And for those who couldn't see this live, this was live tonight. If you couldn't see it live, we'll have the replay. And if we went too quickly on something and you want to review it, the video will be available. As an attendee, you will get access to the video. So you can go back and review anything that was said, listen to it 5 or 6 times so that it really sinks in. And thank you, Mike, and everyone have a great evening.
Thank you.
All right. Bye for now.